Income Tax Update, Past, Present, and Future was a live webinar that was originally produced on Thursday, January 26, 2017. The presenters for this presentation were Mark Heath and Ryan Rutt, both with McConley and Asbury. Enjoy this webinar recap and visit us online at www.macpas.com for more information about our future events.
Good afternoon, everyone. Thank you for joining us on this afternoon from Camp Hill. My name is Ryan Rutt. I am a Senior Tax Manager here at McConley and Asbury, and I am joined by Mark Heath. Mark, say hello.
Hello, everyone.
So we are here to talk to you today, our annual tradition of having a webinar in January, sort of recapping the year that was and also looking forward to the year ahead, and in the middle, seeing what is here and now. We like to do this as tax professionals, realizing that most people do not live in the world that Mark does every day, which is in his tax world. Rather, they are more like Tyler and not as used to being kept up on the news of what's going on, what's being talked about maybe in politics as far as what could be. So I personally am excited to be able to talk about this conversation for the next 50 minutes or so. So without further ado, let's look at the overview for today. We're looking at the past, present, and the future. The past being, how did we get here? What led to getting to this point? Present, let's review what is currently in place in tax law. And then, as so much has been talked about over the past year and a half with politics, what are the possibilities? And I think now more than ever, those possibilities are interesting.
To say the least.
To say the very least, yes. But we'll save that for the end. You're going to have to wait for that to the very end. First, let's talk about the past. What led us to this point? And leading up to 2015, I've been doing this for years and years. Mark, years longer than me. But every year it seemed that there was a round of uncertainty that would come around. Not every single year, maybe every 2 years. But every December it seemed that there was talk about legislation that could happen that had been talked about all year long but hadn't been put into place. And it was just uncertainty. And we would be telling clients, we think this is what's going to be holding for this year, but we don't know until Congress acts. And I called it the annual game of chicken, where one side said they were going to do this, the other side said no way. And it would be like that from about, I'd say, April through the end of the year. And then magically, at the very end of the year, something would get passed. Sometimes, I guess it was January.
Yeah, sometimes it would be January. Sometimes it wouldn't be until after year end. And it is really interesting how taxes have become such a policy shaper for government. And goes outside of taxes to the extent that tax laws and rules were being shoved into other bills to try to entice different lawmakers to pass something that is completely unrelated to taxes. If you look over the past 30, 40 years, before the last 5 or 10, taxes were largely kind of a benign. It was based on a formula of this is the revenue that we need. This is the revenue that we believe would be generated in the private sector if we give these tax cuts. And then it was largely just a math problem. But since then, it's become such a hot-button issue where politicians we've used the joke in the past, politicians are holding taxes ransom to try to get other things passed because they know that the business community could not move forward without these tax changes, so they would hold the tax changes hostage to try to get other things passed.
So for example, I think a couple examples come to mind immediately. I would say at least 5 years ago, when AMT had been enacted decades ago, they had never put in inflation indexes. So every year, what would happen is unless Congress acted, they were going to that index or what AMT was based on, the exemption amounts would fall back to like 1960s levels or something like that, and it would basically subject millions of Americans to a tax they were never intended, basically tax increases. every year, everyone knew that there was going to be a patch put in place to get that thing passed. Everybody knew it, but it'd always wait, or a lot of times it would wait until December because it was the impetus for having something else passed. Same thing happened with the research credit, which we'll talk a little bit about later, until it became permanent. It was something every year. It was sort of the locomotion. It drove everything else, and everybody knew it was going to get passed. There was no way it didn't get passed. But it became that giant game of chicken. Words like fiscal cliff and sequestration and all of these other things come to mind when thinking about how politicians have kind of toyed around with tax law in the past. That is until last year, we talked about the PATH Act of 2015. And what the PATH Act of 2015 did was finally put an end to this kind of revolving madness and made permanent many of these items that were temporary in the past. And so that's what kind of led us to our current state. So that's what we're going to talk about today. We're going to review about what did the PATH Act of 2015 accomplish, where does it leave us for 2016, the year that was, where does it leave us for 2017 as we look forward, and then we'll go beyond that a little bit later in our presentation. For the present, we want to talk about, I think the word I'd use is certainty. For the first time in years, last year, we could finally say to clients, not only do we have in place what would be for 2015, but we have tax law in place for 2016, 17, and in most cases, permanently beyond that. Let's start off with Section 179 expense. High-level overview is that for businesses implementing new equipment, new expenditures that would normally be depreciated, if you are under a certain threshold of total fixed asset additions put into service, you can just simply write those off up to a certain limitation. From this chart, you can see back in 2002 when it started, the amounts were very low, $24,000 of expense as long as you had less than $200,000 of total investment. That means if you had put in $250,000 of eligible additions, you could not take any Section 179 expense that year. Well, it went up slowly over the years to about 2008 when it jumped to $250,000, and then 2010 through 2014, you can see it's $500,000 with a $2 million limitation. Much larger. The largest companies still cannot take this. Your like Walmarts of the country cannot take this kind of deduction. But for many businesses, this is something that they can take advantage of. They can immediately write off their investments, and it's a very popular provision. 2010 to 2014, if I may point out, most of those years, it was only late in the year, like we just talked about, where it would be implemented that, yes, we are going to do the $500,000 limitation again with the $2 million investment limitation. Last year, it became permanent. So like 2015, 2016, and 2017 have $500,000 Section 179 limits. And this has actually been indexed for inflation. So technically for 2016, the investment limit is $2,010,000, not the $2 million that's listed there. So this is, again, something that is very popular, and we can tell you with certainty, at least for now, that this is going to continue indefinitely.
For today, it's absolutely definite.
For today, it's absolutely definite. That is right. So I mentioned in that there's a limitation of $500,000 for the expense, up to $2 million of investment. Generally, that applies to personal property. And there are exceptions for qualified real property, which we deal with in this slide. Qualified real property has three basic categories, being leasehold improvements, restaurant property, and retail improvement property. Leasehold improvements would generally be if you're owning or if you're renting a building and it's more than 3 years after the building. They don't want you basically moving into a new building and then doing all the construction. It has to be 3 years afterwards. Restaurant property obviously would be for restaurants with at least 50% of the space being used for that, and a retail improvement property, which would be retail stores. These are carve-outs, I guess you could call them, for real property in a way to encourage investment amongst businesses. There used to be a separate limitation for like $250,000 that could be used for the qualified real property. That's been eliminated as part of the PATH Act. Now it's $500,000 just total. It's simplified a bit. And also there used to be a limitation specifically excluding air conditioning and heating units from being under the definition of qualified real property. That is no more. Those are now eligible as long as they fit the definition of qualified real property. Otherwise, can now be written off for Section 179. Mark, we would see this a lot with business clients we work on, Section 179 being popular.
Yeah, it simplifies things a lot for smaller businesses because you don't have to go through the rigors of entering things into a fixed asset system. You know, if you're a couple $1 million company and you're buying $50,000 worth of desks, computers, chairs, whatever every year, you don't have to worry about setting up a fixed asset system and, oh, what's the proper useful life for this? And, oh, am I taking bonus depreciation? Oh, but I have a reviewed financial statement and I have different lives for the financial statement, so I need to make sure that's right. And then I need to do my book tax adjustment to get the proper depreciation expense. It's with this, it's just we expense it as we buy it. It makes things a lot easier, a lot more simple. So yeah, it's very popular, and you're obviously getting a return, tax return, much faster than having to spread it over a few years.
That's right. So especially if you think about, excuse me, about the end of the year where maybe there is a purchase that could be made, and you've already put in $1.5 million maybe $200,000 of investment. The return on investment, if you put that in December, a $300,000 piece of property, you can immediately write off, take it times your tax rate. And it depends on whether you're a C Corp or a flow-through business, but even if it's a flow-through business, it goes through to you personally. So it doesn't stop just because the entity itself isn't being taxed.
I do find it interesting, though, that they say they want to make things permanent. They want to make it more simple, predictable, et cetera, et cetera. But then they say, oh, but okay, we're going to throw some real property stuff in here, and we're going to allow it for leasehold improvements, but only leasehold improvements that come in after you've already been in the building for 3 years. So then, they can never quite just say, hey, we're going to do this, make it simple. They always have to add this other stuff in it just to make it a little more complicated. Although I have to be careful what I complain about because it's how I make my living right now.
Well, and teasing again about the future, but there are ideas being thrown out there about immediate expensing of capital, of all capital, from what I understand, or most capital.
We'll get to that.
Yeah, that will, again, right now, in the present, we have the current rules as complicated as they can be. The next slide, go ahead.
No, disregard.
Okay. All right, next. The qualified leasehold improvements also have a 15-year recovery period. For most commercial buildings that are placed in service in a business, the lives on that stipulated by the IRS, it's not up for debate, would be 39 years. Whether you think it's only going to be there 20 years or not, it's always 39. Why 39? I have no idea. Why not 40 years, Mark? Do you know?
I would love to know the answer to that question.
A lot of those questions just simply we don't know. But it's a 39-year piece of property, and it's also not eligible for bonus. So if you think about that in terms of a qualified leasehold improvement, or a restaurant going from something that would normally be placed in service 39 years, about 3%, if that, depreciation, or 2.5% of depreciation every year, and then throw it into it's 15 years now, so much quicker return on investment. And B, Section 179 eligible, which it could be written off completely. There is a large incentive to have something be classified as qualified real property leasehold improvements as opposed to just a regular commercial building. So this has now been made permanent too, this 15-year recovery period. Even if it doesn't, even if you don't qualify for the Section 179, if you're above the threshold, this 15-year recovery period can still be used. One thing to note there at the bottom of the slide, one of the things that are excluded from leasehold improvement category would be structural improvements and enlargements. Just if you're going to make something bigger, that's not necessarily leasehold improvement. That would be largely buildings.
Yeah, a leasehold improvement in the eyes of the IRS is something that you could at least conceivably take with you if and when you leave the building. Doesn't mean that you would take it with you. It doesn't mean it's practical to take it with you. It just means that you physically could. Obviously, structural improvements and or enlarging a building or a room, you can't take that with you.
The other thing that usually went hand in hand with Section 179 leading up to 2015 and now 2016 and beyond is bonus depreciation. This would be it'd be similar. A lot of people tend to use these almost interchangeably, but there are major differences. Section 179 cannot be or can be used on new property. Bonus depreciation can only be used for new property that has a 20-year class lives or less. So bonus depreciation, what is it? Well, right now it's at 50%, meaning any eligible bonus property, once it's placed into service, can be written off 50% for tax purposes immediately. And there is no upper limitation like the Section 179. There is no, if you have $50 million of eligible assets, you can write off the first $25 million. As you can imagine, especially if we were in even larger businesses, this is also a very popular incentive for investment. You'll also note this one is not permanent. The first line, the bolded line in blue there, is where we're at now. Property placed in service 2015, 16, and now into 2017 is all eligible for 50%. Starting next year in 2018, it goes down to 40%, then 30%, and by 2019, this will have phased out completely. Now, again, before the PATH Act, this was one of those provisions that would constantly be being renewed. I think it first started in about 2001, 2002 timeframe. Different percentages. At one point, it was 100%, but it's always been something. It's been something that's been kicked around, and it's something that one of those things you always kind of expected to last. Last year, there was a good and bad part of it. Good in the sense they finally did it for more than the retroactive year, in that we can now plan for it. We could tell clients, hey, in 2016, now into 2017, anything that's eligible for bonus, you can expect to write off 50%, which is a very good incentive. But the bad side being that it's planned to phase out. Now, there are various theories as to why they made it this way, why they made it sort of a 5-year run out. I think one of the reasons, and Mark, you could speak to this, might be that some at least thought that they could be setting the runway for major tax reform. Is that something you buy into?
I don't know. I can say this is one of those items that you alluded to that was held hostage every year and waited until passed until the last minute to get benefits out to tax benefits out there to businesses. I think the biggest problem with this was businesses got so used to it, taking these huge tax write-offs every year, and as long as the bonus depreciation continued, you could continue your capital expenditures and never have to kind of pay the piper because you would keep getting additional tax benefits every year. Well, now at some point, the government was going to have to say either make this permanent forever or say, hey, tough, we need to end this, and you need to be prepared to have these deductions rolled back. And I think that's what they did here. They said, okay, we're going to give you a 4-year run out here, and so get ready for it. It's coming. We have to end it, but at least you now know what it's going to be and you can plan for it.
I guess the important thing to throw in here now is to not assume that everybody understands Section 179 and bonus as an idea. Bonus depreciation can sometimes be misconstrued to say that you get extra depreciation. That's not what we're saying.
Point.
That's not what we're saying. What we're saying is you get it faster. You can write off the first 50% right now immediately, but it really is a timing issue. As opposed to books, which do their own calculation. You can imagine if this was the first year that this was done, there'd be very large tax depreciation as opposed to book. And by and large, for most of the clients that we work with, when they take advantage of bonus, we do see a very large deferred liability buildup, meaning they save taxes in the current years and have been for years, but you'll also see a liability building up on their books that says, at some point, that piper is sitting around the corner wanting to be paid. It's not an indefinite savings of tax.
Yeah, and that's one thing we've been telling our clients to pay attention to, and we've been quantifying this for them, to say, hey, you've had lower tax liabilities now for the past 10, 15 years, and you can't just spend all those tax savings on your new vacation house in Aruba, because at some point here, you're going to have your taxable income is going to end up being higher than your book income, and you're going to have to pay that tax back, which is why this is one of those temporary differences. And these differences are huge for some companies. I mean, one client we have, their total liabilities on their balance sheet are about $300 million, and $100 million of that liability is this deferred tax liability for fixed assets. So, I mean, literally 1/3 of their balance sheet, of their liabilities on their balance sheet, is related to this. And so after 2019, they're not going to be getting these accelerated depreciation deductions, and that deferred liability is going to start to turn, and their cash taxes are going to start going up.
One thing I want to differentiate also in this is when we are speaking in plain facts and when we are giving our own sort of opinions. So it's a plain fact that this chart exists, that this is how bonus depreciation will work. It's opinions now of Mark and myself, or at least myself, of why they did it this way. Again, I would tend to think that this was kind of planning a runway for other tax reform efforts. I have a hard time imagining that we'll get to 2019 with this going away, and there won't be a push from the business community to have something done if we make it that far. Do you disagree with that, or do you saying that you think it is more of a run out of?
No. I think I understand your question a little better now. I don't disagree with that at all, because like you're saying, they're admitting, well, we need larger tax reform, and bonus depreciation has been a Band-Aid to help us avoid the question of having to do tax reform. So let's wind this down, which will kind of force us to look at everything on a broader scale. And do tax reform on a broader scale.
And to say it another way, before we move on to the next point, I think with the annual push, and I call it the annual ridiculousness of the exercise that we went through, there was always sort of a crazed feeling about pushing through legislation quickly and not really. I kept hearing the phrases like, well, we need to get this passed through so that we can now focus more long term. But by the time they would get around to the next, quote, long term period, they had to do another 1-year Band-Aid. I think doing this kind of PATH Act finally gave them some relief of this constant push to make sure things got passed by the end of the year. And honestly, maybe a relief from lobbyists making sure that it got pushed by the end of the year. If you want to get my cynical side, part of me thinks that they had done the Band-Aids the way they did just so the lobbyists would have to come back to them. Not that I'm saying something cynical about politicians. Moving right along. Let's go to qualified improvement property. We'll get back to facts now, not just my opinions. Hopefully I didn't lose people. Okay. One thing I wanted to point out, actually, if you don't mind going back one slide there, Tyler. At the very bottom, we point out that qualified improvement property, QIP, is now eligible for bonus depreciation. If you're like me, when I first heard this, I thought I'd missed something. But no, QIP is a new category class that was created. Now you can go to the next slide. It's called qualified improvement property. In short, you can read what's on the slide there, but in short, what this is doing is it's taking the leasehold improvement concept. Like I said earlier, leasehold improvements can only be done if you're renting a building, and bring something sort of equitable for people who actually own buildings. For example, if Mark rented a building and decided to change the ceilings, put new drywall in, that would be considered, and let's say it meet the other qualifications of the leasehold improvements, qualified leasehold improvements, he could take 15-year lives on that project. It would be eligible for Section 179 if it was beneath the thresholds, and it would be eligible for bonus if he wasn't. So that would be a pretty good deal for Mark. If I owned my own building and did the same exact project and put in new ceiling drywall or something to that effect, since I own the building, I would not get that benefit before qualified improvement property. Beforehand, I would have gotten 39 years non-bonus eligible, non-Section 179. Now with this new asset class, this new complexity, really, if you think about it. You can now, the class life does not change from 39 years, but you are eligible to take 50% bonus on the project. And of all the things of qualified leasehold improvements, I guess beyond Section 179, the bonus depreciation aspect is one of the biggest deals. So this is a way of kind of leveling the playing field, as I see it, between renters and owners. Again, there's some exclusions there at the bottom. You can't enlarge the building. It can't be the internal structural framework. And they also exclude elevators or escalators. So that new escalator project won't qualify, Mark. All right, moving along. A quick summary on the bonus depreciation. Improvements are eligible for bonus regardless if they're subject to a lease, like I just said. You don't have to be a renter necessarily. It doesn't need now the 3-year limit for the qualified leasehold improvements. Doesn't need to be there. And the one other piece that we did not mention is that there was a common area exclusion before. That no longer applies as well for qualified improvements. I think we are through the current fixed asset portion of our program thus far. Unless I missed something, Mark, did you found anything urgent did you want to say?
Not on fixed assets.
All right. I think before we move into the future then, before we get to kind of the interesting times that we're in, we're going to also review a few current happenings, current events in the tax world regarding IRS regulations, court cases. We're going to hit about 5 of these before we get to the future. So the first one, I will hand over to Mark. I think it's about related party debt.
So we're not going to go into a whole lot of detail on this. Actually, the next few slides, we're not going to be going to huge detail because these things aren't going to apply to a ton of taxpayers. It's stuff that everyone needs to be aware of, so you know how to handle it, and in most cases, how to get out of it. It's generally pretty easy to not be subject to some of these rules, but you need to know that they exist. So the 385 regs. Through the course of 2016, the IRS issued proposed regulations under Section 385 that would largely reclassify all related party debt as equity. So if you were a shareholder of a company and you loaned money also to that same company, the IRS would say, no, that's not a loan, that's a capital contribution, and any payments on that loan will be dividends or distributions. We're not going to allow interest expense deductions. We're not going to do this. And the IRS wanted to do this. It was largely to get rid of the whole inversion thing that you've heard about, because the inversion thing where companies are going overseas involves debt for equity transactions, and the IRS was basically trying to just get out of that business and eliminate it. And of course, there was a huge uproar from the community, from the business community, because they were issuing these overreaching regs to try to, that would affect, or that would stop, 5 or 10 companies a year from doing something that the IRS didn't want to do, but it would be onerous on everyone else.
Can you quickly explain why would a company want to invert? Why would they want to move abroad?
Basically, you get your tax home to another country that has a much lower tax rate.
Do most countries have lower tax rates, statutory rates than the U.S.?
Yes.
Okay.
I think there's one that I can think of in developed countries that has a higher rate.
The top corporate rate is 35%, remains one of the highest in the world. So a lot of these corporations were trying to find tax homes elsewhere, and I guess they would be circumventing the rules, but it wasn't breaking the rules.
Right. Yeah. I mean, it was legal. There's a lot of people out there that were paid a lot of money to figure out how to get around these rules, and it was legal. But the IRS obviously didn't like it. Was it the right thing to do? That's not for me to decide. But know these regs exist. They don't take place until 2018, so you don't have to worry about it until then. But do know that come 2018, any related party debt will be subject to strict documentation requirements so that you can prove that it actually is debt. Right now, anytime that you have related party debt. We strongly encourage clients to have a loan document, be charging the proper interest rate that would reflect a market interest rate, and anytime the debt is paid, that cash would actually have to move back and forth, so you jump through all the hoops. That will continue. You will also be subject to much broader documentation requirements showing and proving that it actually is debt.
And one thing I wanted to point out is save this for later as we talk about the future, because this is the IRS reaction to a trend that they didn't like. Congress has started coming up with new proposals to combat this very same thing in a very different way. But we'll talk about that in the future section.
Yes. So moving on, the next point here. This is a piece of a much broader issue with limited partners, LLC members, self-employment tax, employees of LLCs, and whether or not your earnings from an LLC are subject to self-employment tax. There's some really interesting articles out there by a gentleman by the name of Tony Nitty, who writes for Forbes, and if anyone can make tax entertaining, it's him. So if you want to learn, and all of his stuff is very easy to read. It's technical, but in a way that you can understand, that anybody could understand. But when it comes to partnerships and LLCs, one of his most recent articles, he was talking about choice of entity for a new business, and I forget exactly what he said, but he said, if you want this, be a C corp. If you want this, be an S corp. And if you want to understand nothing about how your business operates, then be an LLC. Because all the tax rules, especially when it comes to liabilities, recourse, non-recourse, earnings, income, distribution of income, how the income is allocated is so different for LLCs and partnerships than any other entity. I found that to be at least somewhat humorous.
And I should clarify, LLCs that are taxed as partnerships.
Yes, thank you, Ryan. So in the past, you could not be, if you were a partner in a partnership, you could not be an employee of that partnership. But then LLCs came along, and the IRS basically just said, okay, LLCs are going to be taxed as partnerships unless you elect to be taxed as a corporation. But they never went back, and all the regs only addressed partnerships in terms of employees and owners of partnerships. They never really dove too much into LLCs and never clarified things. So you had a lot of businesses saying, we're an LLC, but the income coming from this LLC out to the partners, we're going to say it's not subject to self-employment tax, even though all of the partners are operating personally within that LLC, and normally that would be subject to self-employment tax. The blatant example was a law firm lost a case where all the lawyers are working in this law firm every single day. It's their only job. This is what they do 100% of the time. And they were taking a very nominal salary or a guaranteed payment and then saying the rest was just business income. It was not subject to self-employment tax. Well, if anyone who knows tax reads the rules, that's just not correct at the partnership level. But since it was not specifically addressed at the LLC level, they took this position. Well, the IRS came in and said, too bad, so sad, you have to pay self-employment tax. But going further than that, they had an individual who owned a bunch of restaurants in an LLC, and he worked in that restaurant and paid himself a guaranteed payment. The IRS even came in there and said, all of these earnings are subject to self-employment tax. I don't know where the case stands right now. I would imagine that individual is appealing it, because that seems to be kind of going the other direction and way overreaching. So, but know that it's out there. If you are the sole owner of an LLC and you're not paying self-employment tax on all your earnings, you might have some exposure there that you need to be aware of.
And there are some limited examples of where you can make the argument that you could get out of self-employment tax, but I would say, like Mark, the default is probably that you'd be subject to self-employment tax.
Limited being the key word.
I'd also point out that if you're an S corp, it's a very different conversation. Whereas Mark was talking about entity choice, LLCs, that are taxed as partnerships, and partnerships generally are the ones that are subject to self-employment tax on most of their earnings or all of their earnings. Whereas S corps, hopefully you've understood that if you own an S corp and you work for it, you should be paying yourself salary sort of via W-2 and a reasonable compensation, as long as you're doing, quote, reasonable compensation, which is a very gray wording. Then the rest of your income that you get from the S corp is not subject to self-employment tax. Why does one get taxed away and the other not? It's arbitrary. It's arbitrary, isn't it, Mark?
Yes.
It's arbitrary.
It is.
All right.
It is.
Moving along. Oh, go ahead.
No, I was just going to say, but yeah, if you're 100% owner of a single member LLC and you don't want to pay self-employment tax, elect to be taxed as an S corporation.
Good advice.
All right. Moving on, partnership audit rules. This is for tax years starting after 2017. If you are a partnership, the IRS wants to come in and audit your partnership and then assess the partners individually and make them liable for, I'm sorry, the opposite, make the partnership liable for the tax instead of having to go after each partner individually. Because what was happening here is, you have a partnership with 500 partners, the IRS comes in, the partnership return is all jacked up, and now they have to go after 500 individual partners to try to collect the tax, because obviously everything flows through to the partners. In this case, that's going to be now the default. If you want to elect out of that, you can, but you can only opt out of it if you have 100 or fewer partners. So generally, that's something you would want to do, because a lot of times, depending on the structure of the partnership, if you have a 2 or 3 person partnership that holds real estate, the partnership may not have any cash in it. So it would be very difficult to it would be a pain. So you would want to opt out of this. But again, this is something you want to make sure that you're aware of and act accordingly.
And again, we're doing this from a high level. If you have questions, please ask them. If we don't get to them in this webinar, we'd be happy to reach out to you afterwards. Moving along to the next case. This is talking about real estate professionals. For those uninitiated, if you have an investment in a partnership, like we're just talking about partnerships as an example anyway, there's 2 main classes of how you would be treated as a partner. You're either active or you're passive. In short, when you're active, you can take losses. When you're passive, you can only take passive losses against other passive income. You can't have passive losses offsetting your active income, which would include W-2 wages. So in general, this is a very high generalization. It's better to be deemed active in these kinds of things rather than passive. If you are a real estate professional, the IRS has carved out a little niche for people who are real estate professionals and say, you can elect to be this, and there are certain stipulations what that involves beyond the scope of this course. But if you are that, then you can have an investment in a real estate be considered active. The problem, and that was addressed in this case, and that it was the assumption of many, is that once you elect to be a real estate professional, all of your real estate activities are automatically active. That is simply not true. What is true is that it can be considered active or non-passive, but you still have to apply the tests that would otherwise be made in order to consider if it's active versus passive. And basically saying the election to be a real estate professional does not automatically make all of your investments non-passive. So if you have elected to be a real estate professional, you might want to check with your CPA to see how things are being treated and if there's any exposure there as well. Now we come to the case involving Giant Eagle. Mark, I'll let you handle this one.
So here's a case where I agree with the final court's ruling in theory. I am completely baffled as to how the court got to this conclusion when you look at the tax law. Basically, this is Giant Eagle. They have gas reward points. Everybody has them, whatever grocery store or whatever. You have gas reward points. The one these gas reward points accrue, and at the end of the business's taxable year, they put a liability on their books because this is the rebate that they're going to have to give to gas customers in the future. The one catch is you actually have to come back the next year and get gas in order to use those rebates. The IRS says that in order to deduct a liability in the year before it's actually paid out, it has to be fixed, what's called fixed and determinable, and has to meet the all events test to prove that it's a true liability. You're not just slapping some random reserve up there to get a tax break. But one key point of those rules says that everything must have already happened in order to fix the liability. What Giant Eagle did was they said, hey, we're going to estimate if we have $300,000 worth of accrued gas rebates on here, we're going to estimate, based on experience, that $250,000 worth of that liability will be paid out. So they would deduct $250,000. The IRS came in and said, no, look at the rules. They actually have to come back and buy gas from you. So not everything has happened to fix the liability. And I was, as much as I like the idea of having a reasonable estimate as a deduction, because that is what would make sense.
That's not the way the IRS works.
That's not what the rules say. And so I couldn't believe, one, that Giant Eagle appealed this, and at the second level, the IRS won again. Giant Eagle appealed it again, which I could not believe. And then what I couldn't even believe even more is that they actually won. That there was a court out there that you can't read the rules and come to this conclusion, but they did. So that's where we're at. However, the IRS has said, okay, fine, whatever, we lost, but we are basically not going to follow this ruling unless you're in the Third Circuit. So they're sticking to the precedent, the absolute most limited possible precedent set by the courts, and say, if you don't live in Delaware, New Jersey, or Pennsylvania, the Third Circuit Court of Appeals, we are not going to follow this ruling. So all the other 47 states, sorry. If you live in these states, yeah, you can take an estimate for a deduction. But it speaks to a larger thing here that there's a court out there that is willing to look at this a little more, not letter of the law, but spirit of the law, and get to what I would say is a reasonable answer. And
the more interesting to me, too, is that the IRS, in losing, is sort of a sore loser and saying, fine, you win, but only for these 3 states. We're going to treat the other 47 states differently. I don't think I've ever seen that before.
Well, there's a lot of stuff the IRS does I've never seen before, but it is what it is.
All right, before we move on to the future, we wanted to touch base, the last thing on kind of the current 2016 slate. Due dates have changed this year. They basically have, well, this is something where I'd say they've made it more rational, where partnerships used to be due 4/15, but individuals were also due 4/15. The issue with that is that usually a K-1 comes from a partnership that needs to go to an individual. So you might have to extend as an individual, even though the partnership was done on time. So they've moved due dates around, basically saying partnerships are now due 3/15, along with S-corps, both entities that would issue K-1s to individuals. And the flip of that is that the C corporations, which were normally due 3/15, have now been pushed to 4/15. Obviously, all these are for calendar years. It's different depending if you're a fiscal year taxpayer.
So the result of this is that you're going to see a whole lot of extensions of partnership tax returns.
That's true. And the last point was also, I think, good, is that the due dates for W-2s has been moved to January 31st. They used to allow to the end of February with electronic filing. That's also, I think, true for 1099s. We don't have it on the slide here. So we're expecting to see information coming sooner to taxpayers. The warning that I would issue is that with expedited filing of these forms, I would also expect to see an increase in the amount of amended forms at 1099. So if you get a 1099 in February, that's great. And if you normally got it in March, I'd still be on the lookout for it to be amended in March, because things change in those reportings.
One other quick thing that we said we were going to touch on from the past, particularly the PATH Act, was the research and development credit. That's a huge credit nationwide, applies to any taxpayer that's making something, manufacturing something, doing any kind of research for a product, whether it's new to you or new to the world. There's a good chance you could get these R&D credits. In the past, these R&D credits could not reduce your tax liability below AMT, but now for certain smaller taxpayers, you can offset AMT with that, and certain startups you can now offset payroll taxes. Because if you're just a startup, you're probably not having a ton of taxable income, but you might have a lot of research and development, so you can still get the benefit for that. That's another one of those. Know it's there, know it's permanent now, know that there's possibly a benefit there, and make sure you look into it.
And we've seen clients who traditionally have not taken R&D start taking it strictly based on this change, because before it was hard to estimate the impact of the limitation of AMT. That's no longer an issue. So before we move to the future, I wanted to put it out there. We're getting a little crunched on time, so we're going to do a really high-level view of the future. Also with that, if you have questions about anything we've talked up to this point or want to discuss anything, feel free to send the questions in online here or to the email addresses at the end. I am thinking at this point we won't have a lot of time unless I see an urgent question that I'd really like to answer. So I just want to let you know, feel free to ask questions. We might not answer them here, but we'll circle back with you afterwards. So the future. Like I said at the very beginning, the past was always, the theme was uncertainty. The PATH Act of 2015 came along and finally injected a welcome dose of certainty for at least 5 years, in most cases, in some senses permanently for a lot of other provisions. Now, as we move into the current climate and looking forward, unless you've been living under a rock, you've noticed that the political landscape has changed dramatically in Washington, D.C. Along with that change in political landscape has I call it the tax nerds all abuzz about the idea that tax reform could happen, and it could happen this year. Now, to say that it's going to be certainly something's going to change is an overstatement, a very large overstatement. While even if everyone agrees, even if it's all Republicans and the president and both houses of Congress agree that tax reform should be done, the devil's in the details. And let me tell you, when everybody can get around and say, yes, we want lower taxes or we want tax reform here, it has to be somebody's got to pay for it somewhere. So the little details is going to be where tax reform will be won or lost. What we're going to do now in the next few slides is at least give an overview of proposals that have been put out there and give a sense of why they are what they are. So we'll start with the Trump tax plan that had been laid out even during the campaign trail. Again, my intent is not to go through every single line item. My intent is to give an overview. When you look at this, you notice there's fewer tax brackets. There's an aim at simplification. There's an elimination of the AMT. There is the elimination of the net investment income tax, which by the way, is tied to Obamacare, so that shouldn't be too much of a shock. Elimination of the estate tax. A lot of things are looking to eliminate, and by eliminating, make it more simplified. And then you also notice that the top rate is 33%. Right now, as it stands, it's 39.6, so that's a pretty large rate reduction. The flip side of that all sounds nice, is that the itemized deductions he proposed to be capped at $200,000. While this doesn't really affect many poor, middle-income, even upper-middle-income households, it would affect a large amount of, I shouldn't say the wealthiest, but also business owners. If you think about an S corporation business owner who has all the flow-through income, they'll have a large amount of flow-through items, even just from state income taxes that the business paid that maybe gets passed through to them, and even from items like charitable contributions. But even if you think about state income taxes, they might have $1 million of state income taxes. If their itemized deduction gets capped at $200,000, that not only means $800,000 of expenses won't be deductible, But anything beyond that, namely charitable contributions, wouldn't be deductible. And so when people, that's the flip side of this. While it might seem nice to have lower tax rates, there's also a negative side to it as well.
There is, because I was curious as to how is this really going to affect if this passes. A whole bunch of random scenarios to say, okay, I'll be honest, it started with me looking to see if I was going to have to pay more tax. But I expanded it out from there.
Always selfish.
Yes, that's how it starts. And I put a whole bunch of examples together, and there's an article out on our website. If you go to macpas.com/news, you can find it in there. It's called Winners and Losers of Tax Reform, and it runs through and gives some examples of, married with 2 kids in a house, single with a child, no house, and just goes through a few different examples to say who's going to pay more tax. And the results were surprising. So yeah, if you want to know specifics of how this might look, you can go there and check that out.
Moving on to the next slide, again, just to touch on the business side as well. Very similar theme on the business side. There's a rate cut down to 15%. That's dramatic, down from 35%. There's fuzziness in pass-through entities. We won't get into that now. But again, you'll see the word eliminate a lot. Eliminate the domestic production activities deduction, eliminate credits, eliminate AMT. The goal seems to be lower the rate, make it more simplified. And that's what you'll hear a lot of people rallying around at first. But again, the actual details, you start eliminating the domestic production activities deduction, that deduction is geared at U.S. manufacturing. Well, now, so the flip side, I could just imagine people coming out and being like, you want to eliminate the deduction, the incentive for manufacturing in the U.S., and that just doesn't jive with everything else that's being said. Overall, it might be a good plan. There's just there's going to be a lot of ruffling of feathers to get it done. Moving on, I also wanted to kind of juxtapose it real quick to the House tax reform blueprint. Go ahead.
Just back to the business taxes piece. Again, I wrote an article about this too, talking about, everyone says, yay, the corporate income tax rate's going to drop from 34 or 35% down to 15%. That's great. However, there's a planning piece in there. Hopefully, obviously, the calendar year 2016 is over now. But if you're a fiscal year filer, you could still be in your tax year 2016, and you still have an opportunity to plan for this. Because if you can accept every dollar of deductions that you can accelerate into the 2016 tax year, you're going to get an offset of 35% at a 35% tax rate. You're going to get a deduction at that level. And for temporary differences, then when you pick that income back up in future years, it's only going to be taxed at 15%. So you can essentially end up getting a 20 percentage point permanent tax benefit from this if you can do anything and everything that you can do to accelerate these deductions into your 2016 tax year.
A similar point can be made for individuals. If you think about a top rate of 33% versus 39.6%, while the end of the year it's through, we're in 17 now, there are still certain things you can do to push taxes off a year. Things like IRA contributions can be made till April 15th. Things like that, or even with pass-through businesses as you're looking on how to treat certain items at year end, any income that can be pushed off to 2017, no guarantee of a rate reduction, but it looks like it's definitely not going to go up, possibly go down. The tax reform plans, there's 2 slides here. The first one here we'll sit on for a little bit as individuals. The next one is for businesses. Very similar to what we looked at with Trump's proposed plan. Eliminate AMT. You see the words eliminate a lot, and you see there's a few quirks in here, but by and large, the similar theme. If you go to the next slide, Tyler, I believe that the top says individual. That's a typo. It should be business taxes. Reduce the corporate rate to 20%, not 15%. No deduction for net interest expense. There's an allowance for full expensing of capital investments. and change to a territorial tax system.
Just to clarify, the allow for full expensing of capital investments essentially means 100% bonus depreciation.
So this is a whereas individual taxes there is a move towards simplification. This is like an overhaul of business taxes, and it actually goes. If you've heard something called the destination-based cash flow tax, the DBCFT for short, this goes hand in hand with that, where essentially they are proposing to roll back what we know as the corporate income tax in totality and replace it with this new type of tax. We don't have, this is not the, you could do a whole hour based on that new tax. It's also called the border tax adjustment that's involved as well. There's a lot of uncertainty around it, but know that it is a possibility and that it would have a very different look and feel than what we currently have. As I was starting to get excited about it from a tax standpoint, I've also in the past 24 hours heard 2 other plans being rolled into place as well. So at this point, I think it's an exercise in futility to try to really nail down specifics of what it looks like. But there is a buzz in the tax world about tax reform.
Yeah, I would say from the border tax adjustment side, something's going to happen. I don't know if it's going to be a border tax adjustment. The president has said he doesn't like the border tax adjustment, but in literally the same sentence he'll say, but I want to put tariffs on all imports, which would essentially be the same thing. So we don't know what's going to happen. However, you should know that if you're importing goods from a foreign country, there's a somewhat decent chance that you will be losing tax deductions permanently for those imports.
Now, just to throw in real quick, the counter argument on that to make sure it's not, if it is something more like the destination cash-based cash flow tax, all the economists agree that one major effect that would happen is that the U.S. dollar would get stronger. So if you're importing items from out of the country, your dollar would go a farther way, and if you're exporting, while you don't have to pay the tax necessarily, your dollar or your sales get weaker compared to the U.S. dollar because the foreign currency won't be worth as much. So the economists will at least say they would offset each other. The tax changes with the currency changes, but all of that again, it's so in flux. And we'll kind of have to take it day by day. I hear one day that Trump is in favor, next day he's opposed, and then in favor. It's a hard it's a hard thing to kind of decipher, but we keep looking for things, trying to read the tea leaves in this kind of crazy environment. So I guess what I'm trying to say in so many words is that before 2015 we had uncertainty. For a while there, I thought we were going to have certainty going forward, 2015, 16, and beyond, but I think we're starting to enter back into a world of uncertainty where we don't know 100% what 2017 and beyond will look like, but we'll be the first to tell you when things come along about future developments. With that, I think I'm going to throw it back to Tyler as we're hitting almost 3 o'clock, unless Mark has anything else he's dying to say.
No, I just want to remind everyone that I deal in facts, Ryan deals in theory, so...
There you have it, folks.
Thank you once again for joining us for this presentation produced by McConley & Asbury. We hope you join us for our upcoming events. You can stay up to date with news and learn more about our upcoming events by visiting us at www.macpas.com. Thanks again and have a great day.